Hello, my name is Andrew Thake. I'm a divisional director with Resourcing Tomorrow. Ahead of our Hong Kong event on the 16th to 17th of April, we're delighted to welcome one of the speakers, who's David Bowe. Just to give a bit of a background for David, he's an independent director of Asia Potash, Zijin Mining and Lingbao Gold. He's also the accomplished author of The Ins and Outs of Global Mining, and he's had over 30 years experience in the mining industry. So delighted to go and have him just to go and share his insights today. Delighted to go and have you with us today, David.
Thank you for having me, Andrew.
Starting off is, I mentioned your book, The Ins and Outs of Global Mining. You've elaborated in great detail to readers how mining is done internationally. As we enter this M&A supercycle where giants like Anglo and Teck are being redefined by their copper portfolios, how has the definition of a tier one asset changed?
Well, the term tier one asset is generally vaguely used by many people in the industry as large, long life, and low cost. Even though Newmont and Barrick did publicly define their respective criteria. Well, no matter what their criteria are, it's certainly great to have them, especially the Newmont version of them, which require them to be in safe jurisdictions. To those that already have tier one assets in their portfolios, congratulations. Well, they can by all means take pride in them. But to those that rely on acquisition to get them, I caution that their chances may not be plenty. Firstly, that space is very competitive, so they have to bid high. Secondly, they will only know whether an asset is tier one or not at an advanced stage. For example, after completion of a feasibility study. Then if you look from the outside at the current Newmont and Barrick dispute on their Nevada joint venture, their intended tier one may not have performed as tier one. It may be a better strategy to chase those that are reasonably priced and that there is a lot of potential to improve. So there is a saying, price is what you pay and value is what you get. It's really what kind of value you can get out of it and what price you have to pay for it.
Mm-hmm. And a follow-up to that is, from Zijin's perspective, the industry is now forced to accept higher jurisdictional. Sorry, is the industry now forced to accept higher jurisdictional and or technical risk to secure the copper volumes required for the energy transition?
I think so. In fact, not only for copper, but largely for most of the commodities, if not all. Well, firstly, we're in the new upcycle in mining. During such a time, typically, all mining properties are more competitively chased. Secondly, geopolitics makes things worse. Having said that, from Zijin's perspective, we have been operating in 5 continents and are quite used to all kinds of operational conditions.
Mm-hmm. The panel you're on at Resourcing Tomorrow Hong Kong identifies M&A as a form of geopolitics. Given your experience having navigated both Western mining standards and Chinese strategic interests, how do you see the friendshoring trend affecting Zijin's ability to compete for assets in Southeast Asia and Africa?
My observation is that friendshoring happens with the government interventions on advanced stage mining opportunities. For example, the host government may want to allocate certain mining properties under their direct control to entities of foreign governments as an intergovernmental arrangement. It may have an impact on Zijin competing for the same properties, but I think the impact is generally limited, at least in the short term. If you look at Zijin's past M&A transactions, they're mainly from Canadian or Australian companies or Western financial institutions on commercial or market terms, and very few from the host governments directly. I think it will stay that way for the foreseeable future for good reasons.
You've spent a career bridging the gap between Chinese operations and global capital. As the panel discusses Hong Kong as a resource-linked capital hub, what specific reforms or advantages does Hong Kong need to maintain to ensure it remains the primary bridge for mining M&A, particularly as competition grows from hubs like Riyadh or Singapore?
The Hong Kong Stock Exchange is the natural place for Chinese mining houses to accept international capital, and it has played such a role extremely well over the past years. And they are currently getting really busy. And they have successfully fostered an ecosystem by accommodating quite a few Chinese mining houses, big and small, to go get listed or dual listed there. A good example is that Zijin Gold International was the largest mining IPO globally last year. I believe there is a pretty wide gap between Hong Kong and Singapore and Riyadh as of now. But there is more they can do. You can call it reform. I have made comments in my speeches in China that the Hong Kong Stock Exchange can have the full mining spectrum if they loosen their listing rules a little bit further to accommodate the so-called junior mining companies, which are pre-cash flow explorers and developers. So far, the TSX and TSXV, meaning Toronto Stock Exchange and their venture board, and the ASX, which is Australian Stock Exchange. These are the dominant bourses for the juniors.
One of the discussion points on the panel is the royalty and streaming revolution as a hedge against inflation. Based on your long-term view of mining cycles, do you believe the shift away from direct ownership is a temporary reaction to current cost pressures, or is a direct owner-operator model becoming too risky for the modern institutional investor?
Well, the royalty and streaming model has proven to be highly attractive throughout the cycles by isolating capex overrun or OPEX escalation. So they enjoy higher relative valuation. As a result, that space is much busier with approximately 40 players now than 15 years ago when there were only a few of them. However, I don't see it as a shift away from direct ownership. There are still plenty of institutional investors that are well versed in mining, investing in growth-oriented juniors or explorers and developers, the so-called juniors. They are chasing potential multiple times of returns. Comparatively, the royalty and streaming model is more for stable or less volatile income.
Well, it's been an absolute pleasure talking to you today, David. We're really looking forward to seeing you at Resourcing Tomorrow, Hong Kong on the 16th to 17th of April. And once again, thank you very, very much for your time, David.
Thank you again, Andrew, for having me. I look forward to participating in the Hong Kong event.